Most people have no idea what a real million-dollar portfolio actually looks like from the inside. Not the highlight reel, not the cherry-picked wins. The real thing, including the positions that wrecked me, the tax mistakes that cost me thousands, and the single decision that changed everything. Today, I'm opening it all up. Every holding, every return, every regret. Here's what nobody tells you about building a $1 million portfolio in America. The internet is flooded with people flexing screenshots, but you never see the full picture. You never see the margin call at 2 a.m. You never see the year they lost $80,000 and quietly deleted their channel. You never see the portfolio that looks great on paper, but is so tax inefficient, the IRS is basically a silent partner taking 30 cents on every dollar. That was almost me. And if you're somewhere between just getting started and I think I'm doing okay, this video is for you. Because the mistakes I made, you can skip every single one of them. Let me give you some context. I didn't inherit this. There was no crypto jackpot, no lucky IPO. I built this over 11 years, through 2 jobs, 1 layoff, a divorce that cost me more than I want to admit, and a period where my 401k was basically my only investment because I was too scared to do anything else. The first 100k took 6 years. The next 900k took 5. That's the compounding curve they talk about in every finance textbook, and it's absolutely real. But so is the emotional roller coaster that comes with it. I've held through 40% drawdowns. I've panic sold at the worst possible moment, and I have the receipts to prove it. Coming up, I'm going to show you the 3 positions in my portfolio right now that I'd never tell my broke friends about, and the one holding I'm most embarrassed to still own. Stay with me. Okay, let's get into it. Here's how my $1 million portfolio is actually structured. Roughly, 60% is in tax-advantaged accounts, my Roth IRA, my old 401k that I rolled over, and a SEP IRA from freelance income. This is the foundation. This is the stuff the IRS can't easily touch in retirement. The other 40% sits in a taxable brokerage. This is my flexible money, things I might need before 59 and a half, and frankly, where I've made most of my dumbest decisions. Lesson 1. If you're not maxing your Roth IRA before investing in a taxable account, you're leaving free money on the table. The contribution limit is $7,000 a year. That's your first move. Every single year. Now, the wins. My biggest position is the S&P 500 index fund. Boring? Yes. Life-changing? Absolutely. Over the past decade, that single holding has outperformed about 85% of actively managed funds, and I've done literally nothing except not sell it when the market panicked. Second biggest winner? A small allocation to REITs, real estate investment trusts, that I added during COVID when commercial property got hammered. That position is up 140%. And here's what nobody in my real life knows. I have a tiny 2% position in a single stock bet I made 5 years ago that turned $8,000 into just over $61,000. I tell you this not to brag, but because that 2% allocation is exactly the right size for a high-risk bet. It changed my life. It also could have gone to 0. Position sizing is everything. Coming up, the loss I still think about at 3 a.m. Don't skip this part. All right, the ugly stuff. In 2021, I put $55,000 into a speculative tech ETF that was getting hyped everywhere. You know the type. It was up 200% in a year, every finance influencer was talking about it, and I convinced myself I'd done my research. I lost $38,000. $38,000. That's not even the worst part, because I sold at the bottom, locked in the loss, and then watched it partially recover 6 months later. Here's what that taught me. Volatility is not risk if you can hold. Volatility is risk if you need the money or can't stomach the drop. Know which investor you are before you buy, not after. I also got hit with a $14,000 surprise tax bill in 2022 because I didn't understand short-term versus long-term capital gains. Selling within a year? You're paying income tax rates, sometimes up to 37%. That is a brutal, avoidable mistake. I'm telling you this so you don't learn it the way I did. What I'd do differently. So if I could start over today, here's what I'd do differently. 1. Automate everything from day one. Automatic contributions to the Roth IRA. Automatic S&P 500 purchases. Don't give yourself the chance to overthink it. 2. Never invest money you'll need within 3 years. I broke this rule twice. It cost me both times. 3. Hire a fee-only financial advisor, not a commission-based one, at least once a year for a portfolio check-in. It costs $300 to $500 and has saved me multiples of that in bad decisions. 4. Learn enough about taxes to have an informed conversation with your CPA. You don't need to become an accountant. You just need to understand Roth conversions, tax loss harvesting, and what triggers a taxable event. That knowledge alone is worth tens of thousands of dollars over a lifetime. Look, I'm not showing you this to impress you. I'm showing you this because I spent a decade wishing someone would just be honest with me about what building real wealth actually looks like. It's messy, it's emotional, and it is absolutely possible. If you want a free breakdown checklist, the exact framework I use to review my $1 million portfolio every quarter, comment the word READY down below, and I'll get it to you. And if this video gave you even one thing you didn't know before, hit subscribe. I drop honest, no-fluff finance content every week. No sponsored garbage, no fake flexing, just real talk about building wealth in America. I'll see you in the next one.